You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Even before artificial intelligence capabilities accelerated, the U.S. economy was experiencing a post-pandemic surge in productivity, allowing us to consume more goods and services with the same amount of labor inputs. Some Fed officials have pointed to the accompanying downward pressure on prices as a reason to cut interest rates, but identifying productivity growth in real time is challenging, and only time will tell whether AI lives up to all the hype. On today's episode, we talk with Chad Syverson, professor of economics at the University of Chicago, about the difficulty in measuring productivity, the typical pace of technological integration, and how AI could impact inflation and interest rates in the future. Stay tuned. Coming up soon, our interview with Chad Syverson, but first, a quick market update. The war in Iran continued dominating investor focus these past 2 weeks. Aerial attacks from the US, Israel, and Iran are leading to significant disruptions in global commodity markets, particularly in the Strait of Hormuz between Iran and Oman. WTI crude oil spiked as high as $117 per barrel on March 9th, but is now trading just under $100, up from a pre-war price of $67. Natural gas prices have been somewhat steady in the US, but the impacts are much more pronounced in Europe and Asia. Prices for other essential economic inputs are also rising for things like fertilizer, fuel oil, and jet fuel that will pass through to both headline and core inflation measures for US consumers. The Fed left interest rates unchanged this week, as expected. The dot plot shows the median FOMC participant projects one rate cut this year, just as in the December SEP. Inflation projections this year shifted up a few tenths of a percent from December, but the out years suggest the Fed believes, for now, the war's inflationary impacts will be temporary. Chair Powell's press conference underscored the FOMC's low level of conviction in their forecasts in light of the war. Last week's inflation data told two different stories of pre-war price pressures. Core inflation in the February CPI stayed at a low 2.5% for the second straight month, while the January PCE showed underlying inflation is stubbornly above 3%. There are methodological differences that explain the divergence, but more importantly, the Fed targets the PCE, so FOMC participants were happy to keep policy on hold even before the war presented new inflationary risks. The Treasury curve bear flattened 13 to 20 basis points over the last 2 weeks as bond investors weighed the war's impacts on inflation and Fed policy. After the Fed meeting, the bond market is now fully pricing in the next rate cut in 2027. A federal judge last week quashed the subpoena served to the Federal Reserve by the Department of Justice. The DOJ has vowed to appeal the ruling, which risks dragging out Kevin Warsh's Senate confirmation to become the next Fed chair. North Carolina Senator Thom Tillis says he will block any vote until the investigation comes to an end. That's all for the market update this time. Now our interview with Chad Syverson. Our guest today is Chad Syverson, professor of economics at the University of Chicago. Chad, thanks for coming on the podcast.
It's my pleasure. Thanks for having me.
Our topic today is productivity, how to measure it, how it changes the economy, and whether AI's impacts will follow a similar path as previous innovative technologies. So I want to start by first talking about the best way to measure productivity. For listeners who aren't familiar, the labor productivity stats reported by the government take overall economic output and then divide it by the number of hours worked. But there are a few examples that show how this can be misleading. Quarter to quarter, GDP data can be noisy, so productivity growth, for example, fell 2.1% in the first quarter of last year, and then rose 4.1%, a big swing in just 3 months. It can also go way up or down if our spending patterns shift to things that are less labor-intensive, as they did early in the pandemic. And also, at the peak of a recession, firms hold on to their most productive workers, and then will hire the least productive workers late in the cycle. In none of those instances I mentioned would I say we have meaningfully changed our knowledge of how to produce more stuff with the same inputs. So, Chad, how do you get around these distortions when you're researching productivity?
Well, you raised something really important, which is a big job of productivity researchers is trying to separate the signal of technological change from the noise of everything else. So, like you mentioned, those commonly followed productivity numbers that we see are ratios of the one that we talk about the most is labor productivity. So it's output per worker hour. So it's a ratio of output to input. The input happens to be one worker working 1 hour. All productivity measures, and there are many of them, are in one basic way or another a ratio of output to input or input or inputs. But like you pointed out, those things can move around for reasons that have nothing to do with technological change. So what you have to do as a researcher, sometimes we care about why they move around for reasons other than technical change, but given that productivity is probably our best measure of technological change, we have to do a lot of work to try to separate the signal from the noise. And there are different ways to do it. But none of them are automatic, and we don't have a little, secret table that we can just go translate the number that gets reported into what's true technological progress. We have to do work to get that, and even the outcome of those sorts of analyses are themselves uncertain. So it's all helped by the more data we get. The more we learn, because noise tends to wash out over time. Other things that move around productivity, like you talked about compositional changes in the quality of workers over the business cycle, for instance, that stuff also tends to get washed out over time. And there's sort of ways we can try to adjust for that. So the more data you get over the long run, the more likely it is that the big changes you see are technological change. But you're never quite able to fully just dial in on only the technological change, and you can ignore everything else. You're always struggling with that one way or the other.
I think of the consumer electronics I had 25 years ago, and today they are so much cheaper and such higher quality. And then the admittedly very simple haircuts I have always gotten, they take the same amount of time, quality is basically the same, and in nominal dollars, the price has gone up. Why do some sectors have trouble increasing productivity? Are there innovations out there and we just need to discover them? Or do you think certain sectors are prone to being less productive?
You bring up an example of what economists call Baumol's cost disease, which is some sectors of the economy just seem much less amenable to productivity improvements from technological changes. Barbers is a classical example, although it was a friend of mine just sent me some data. Someone actually wrote, I think it was someone in the U.S. government in the 40s had written a report on productivity in hairdressing, and they had actually found over like a 20-year period the barbers had become more productive. I think it was from 1915 to 1935 or something like that, which is maybe true. You go with scissors to electric clippers or something like that.
Yeah, at some point they had pretty good alcohol to make sure that you don't get big infections from a cut on your neck or something. I could see there are productivity gains, but in my lifetime, I have not particularly acknowledged them.
No, and look, there's a reason why barbers is such a classic example, because it is hard to imagine, at least in the past several decades, how there's been technological change that's mattered there. Another classic example is if you want a live string quartet, they're probably not able to play any more music any better than a really good string quartet could have 100 years ago. Okay, so there's no productivity gains there either. On the other hand, for a lot of other production processes, certainly in manufacturing, we've become much, much more efficient at putting stuff together. Interestingly, I've done work with Austin Goolsbee on the construction sector, and even though you might think at a 30,000-foot level, that's kind of like manufacturing. They're taking pieces and putting them together to create something else that's then sold to a final user. They don't seem to have experienced the productivity gains that manufacturing has. The answer to your first question, while unsatisfying at some level, because it doesn't really explain why, is that there are certain technological processes that have been more amenable to productivity enhancing improvements, whether it's automation or management innovations that have reconstructed the processes through which things are made that have resulted in them becoming more efficient, energy efficiency gains of many different kinds, that sort of stuff. Those sectors, those industries that are big on those kinds of processes have tended to see faster productivity growth than other sectors where the nature of the process itself isn't quite so amenable, at least with the tools we have today, to productivity gains.
Yeah, I think it's interesting that you bring up the string quartet because obviously, as far as the number of people who are required in a string quartet, it's been four for as long as they've been around. And I think it also speaks to the price increases in a lot of sectors that we seem to have challenges controlling the costs. So daycare, a lot of daycares are regulated so that there's a certain ratio of adults to children, and that, until we get the robot nannies, can't really improve. The way that I see it is it fair to say then that sectors that are more labor intensive can be more difficult to find those productivity gains, or is that an oversimplification?
I think that's not a bad high level way to think about it. I mean, one thing to be careful of, though, too, is it could be that the causality is the other way. They're labor intensive precisely because there haven't been a lot of productivity gains. So they need a lot of people to get the process done because it's hard to find ways to do it more efficiently. So you just have to do it by scaling the workers instead. But yeah, I think at a grand level, it's fine to think of you're going to have a harder time finding productivity gains in really labor-intensive processes. There are obvious exceptions to that, but if you just want to think about things again at a 30,000-foot level, that's not a bad rule of thumb.
Yeah, I can see how that causality can go both ways because a couple hundred years ago, maybe agriculture was very labor intensive, but then machines were able to replace a lot of that work. So it wasn't the labor intensity that was the cause of the difficulty in finding innovations. It was more the symptom. I want to go back to your example about construction productivity. What do you think it is about construction that makes it so uniquely weak for productivity growth for so long? And how much is this contributing to higher housing costs that we see?
Great questions. The first part about what we think is going on. So Austin and I in that paper, I think both of us, if we're honest about what we could do in that paper, is we could rule a lot of explanations out, but we really didn't find any smoking guns. Like, aha, here is construction's problem. This is why they aren't seeing productivity growth. Now, if you ask me, based on what I've seen about the industry and what I've learned about how it works, but that we didn't have data to look at in this paper, so we really couldn't do anything about it. I think there are two big issues that are potential explanations in part for the slow productivity growth. One is sort of external to the industry in some sense, the other is internal. The external part, and this has been getting a lot of conversation in policy circles lately, is there are a lot of ways that the construction process can be slowed down or stopped or otherwise impeded. And that can make projects first of all, get hard to get going in the first place. But even once they're going, can be very difficult to undertake. There are, 1,000 mouths that need to be fed for big projects, and that can be, in the end, wasteful. And so you basically, call this just the political economy of construction, and there's a million subcategories of that. I think that's one issue, though, again, to be fair, we don't have data on that stuff, so we couldn't look at it, test it formally in the paper. The other thing sort of internally to the industry is that there is a notion amongst some construction companies that disruptions to the process, in some ways, they are not just disruptions, they're opportunities to make margin. Change orders, other things that crop up that need to be addressed. Often those things get remunerated at a higher margin rate than the initial contract. There's also a limited incentive for some construction producers themselves to try to think ahead to such a point where you'd want to eliminate disruptions, because in some cases, those disruptions are the very places where you can earn some of your profit. And so there's also like a limited internal incentive in the industry in some settings for them to think through ways to make things run more smoothly. So I think you have a combination of these two, this external thing and this internal thing, that have basically led to not enough effort, or the inability of efforts that are taking place to really move the productivity needle. But again, that's speculation, and that's not something Austin and I could test formally in the study.
And how much do you think that stagnation in productivity is contributing to the higher housing costs we're seeing today?
So I actually have a paper recently with Brian Potter, and somewhat surprisingly to us, there doesn't seem to be a big relationship, at least over the past couple of decades, in changes in construction costs of housing and changes in the prices of housing. So if, for example, if you look across cities in the United States and you ask yourself, okay, which cities saw the fastest house price growth, which saw the lowest house price growth? All right. What's the correlation between that house price growth and construction cost growth in that city? And it's basically zero. So there is some fair amount of variation in construction cost growth across cities, and there's a lot of variation in house price growth across cities, but they just happen to not be correlated, at least over the past 20 years or so. Before that, there was a stronger correlation, although even then there was a lot of variation in stuff that moves house prices around. So changes in house prices these days seem to be coming more from not the actual cost of putting a house together, which is, you got plywood, you got 2x4s, you got drywall, and you got to assemble it, but rather other non-construction costs that show up in house prices. That could be permitting, could be the buying the lot itself. Land prices aren't in these construction cost metrics that we use, which it ties to regulations and stuff and many other things beyond that. So while construction, all else equal, we want the construction sector to become more productive and building costs to fall, that doesn't seem to be the big factor in explaining increases in house prices. All that said, if you just look across cities at price levels and construction cost levels, they are correlated. Cities tend to have the highest house prices, but there's a ton of variation in prices that isn't related to construction costs at the same time.
Yeah, sometimes when I think about house prices through this productivity lens, land is pretty much fixed around the world, and a lot of regulations stop us from building too high. So we have the technology to put more housing on a given piece of land. It's an elevator or a set of stairs. But oftentimes local zoning codes or regulations are stopping us from utilizing that technology.
No, I think that's exactly right. And those limits are built into the land prices, which then show up in house prices.
I'm of two minds when I think about whether the rise in work from home post-pandemic has been good or bad for productivity. On the one hand, I could see people accomplishing tasks in 35 hours that used to take them 40. They're less distracted, happier, and better rested from avoiding a commute, all of that. But then by not having the collaboration, the proverbial water cooler chat, there are some companies that don't get that big new idea that could really drive them forward. And maybe this just gets to my first question about the difficulty in measuring productivity. But what's your take on how work from home has and will affect productivity?
My instinct is very much in line with yours, which are these opposing effects, which is for a lot of people, saving the commute and the stress and time that goes with it makes them more productive at home. They can get the same amount of work done in a few less hours, maybe even more if they find the home environment more pleasant than the office. So you can imagine some productivity gains coming from that. By the way, it's a little hard to measure productivity gains in terms of people saving time and commute. That doesn't go into our productivity measures, but it does make people better off if they find commuting costly, not just in dollar terms, but in psychic terms too. But even setting that aside, just what they're actually doing with their time on task at home, you could, again, imagine some cases where they become more productive. On the other hand, we also know, the collaboration in many settings leads to productivity gains. One big picture reason why we have cities is because putting people together in work situations actually makes them more productive. These economists call them agglomeration economies, but it basically means working around other people makes everyone more productive. And you lose an element of that, can lose an element of that, and work from home. Yes, Zoom and that video conferencing is a substitute, but I think most people think it's not a perfect substitute for being in the same room and batting ideas back and forth with coworkers. And so you lose that element if you've shifted to work from home. Which is bigger? I think it really depends on the setting. You're working in a very creative, innovative, kind of brainstormy kind of operation. I think that's where you want those in-person interactions, and losing them means you lose a lot. I'm in academia. One big part of my job is to do research. Research is a very collaborative effort. It comes from batting ideas around with your colleagues. And I can tell you, all of us want to get back to the office, and we are all back at the office because we're just better at doing that part of the job when we're around other people talking about our ideas together. And I think other settings like that effect tends to dominate the work from home benefit. In others, you could imagine it's the flip side. The innovative, creative part is less important. What's more important is how effective someone is once they're already in front of their computer or whatever. And in that case, you'll see more gains there. So I really think it's like a production process specific thing. Which of these two opposing elements is quantitatively more important?
Clearly, the productivity topic today revolves around AI. And it seems like the speed at which it evolves is a big part of how the economy is going to respond to any disruptions. We're recording not long after a simple think piece went viral that envisioned a future where AI moves so quickly that it leads to mass unemployment and financial collapse. I get the intuition of looking at what AI can do today and then assuming it can be integrated everywhere in the economy overnight. But the seeds of the internet, for example, were planted in the 60s and 70s, and it was only 10, 15 years ago that 90% of US households had internet access. So give us a sense of what the timeline is, historically speaking, for when a technology is first identified and created, and then when it makes an economic difference.
So historically, one tends to find a gap of around 20 to 25 years between the initial commercialization of a general purpose technology and where you really see it starting to hit the productivity statistics. Decades long sort of lag is not unusual. Now, does that guarantee we're going to have to wait 20 years? No. And on some metrics, AI is already diffusing faster than technologies of the past. Even once the technology is available and at least some of its potentiality is apparent to anyone, you still often have, real serious lags in diffusion and implementation that go on for a million different reasons. And so you don't see the full productivity benefit for quite some time, where that used to be decades. I don't know if it'll be decades this time, but I think quite some time is going to be years, is my guess still, for AI to see the full productivity benefits, because this is just how technology works. And it's not like companies of the past had no less incentive to try to purchase and implement more productive technologies if it was going to make them more money. That was true of the steam engine instead of the water wheel. It was true in terms of electricity versus the steam engine. It was true in terms of computers versus typewriters. Nevertheless, all those things took decades to be fully diffused through production processes. I think the imminent mass inflation is considerably overstated. Sort of how much labor market disruption can we sustain without big changes? Generally quite a bit. I mean, there's a lot more labor market turnover than people think there is. So we can have a lot of movement in labor markets before it becomes a mass sort of problem. And you put that on top of the fact that there are diffusion lags coming from a many different angles. makes me a little more sanguine about that part of what AI might do. On the good side, we could experience considerable productivity benefits from AI as well, which productivity gains it just make us richer. We have to figure out how to distribute those extra riches, but by definition, that's what productivity growth is. You have more goods and services made from the same inputs. You don't have to expend any more resources to have more things to enjoy. That's an increase in income, and that's the benefit of productivity growth.
I think you make a lot of good points there, and I'm not going to confidently say that AI will be the outlier in all those historical examples because ChatGPT did sign up. I think it went to 100 million users, so much faster than Facebook or any other technological implementation we've seen in the past. On the other hand, companies are very risk averse. It's very pricey to put these technologies into their existing infrastructure. So, if nothing else, maybe just the way that our industries are set up and the way that the human mind does not want to take many risks, it's going to stop implementation from taking a year before AI becomes as ubiquitous as electricity.
Yeah, I think that's right. New technologies, there is an element sometimes to them of, well, just unplug the old thing and plug the new thing in. But history has shown that productivity gains from that pure replacement effect is pretty modest. What really drives productivity growth of new technologies are changes in the things you're doing in the first place. You could do a bunch of stuff you do now in different ways with the new technology, but it takes time for people to figure out what those things are and to change how organizations work, change the kind of workers they hire, whatever you have to do things in a different way. And that's another source of these diffusion lags and a reason why it's not just, swap out the old thing for the new thing and all of a sudden, you're making 10 times the output you were a year ago or something like that.
You alluded to the bottlenecks in the construction industry. That's my word, not yours. But I get the idea that you can have so many issues that are stopping innovation from breaking through. And as long as there's one thing still in the way, it's not going to break through. So when we look at the history for things like electricity, the internet, the steam engine, do productivity increases happen incrementally, or do they kind of move slowly and then they reach some inflection point where there's an acceleration because finally they got past those bottlenecks?
Yeah, there's a little bit of a S curve kind of thing where it's slow at the beginning, it accelerates, and then as diffusion starts to hit its limit, it slows down again. It's not quite like a 0, 0, 0, then boom, you're at just 100% from that point forward. It's not that strong, but there is a little bit of an S curve thing. The joke in academics is progress happens one retirement at a time. There's a little bit of that too. It's like new technologies are implemented one company exit and company entry at a time. Some companies can't change their business model, so the only way the new way of doing things diffuses is the old ones go out of business and the new ones come in doing things a different way, and that takes time too. So there's a little bit of everything, but it adds up to gradual, if not constant, sort of diffusion process.
ChatGPT 3.5 came out Thanksgiving of 2022. Claude Code is about a year old, so the most hyped parts of AI are still relatively new. Do we see AI in the productivity data so far? So we've been talking about how it's difficult to identify it in the data and also what the typical historical pace is of adoption. What do we see in the productivity data so far?
Yeah, two answers. One is at the micro level in some well-identified case studies where you can really measure things well. It's very clear when when people started to use AI in the process. There's evidence that AI has improved productivity. At the macro data, you got to squint pretty hard. And even after squinting, it's not quite sure that AI is showing up yet. Yeah, there's a little bit of acceleration in aggregate productivity growth, which is great. That started kind of before AI was a thing. I mean, it started kind of mid-2022. If you look across industries, maybe you could tell a story where the industries that are more amenable to AI substitution are seeing a little faster growth than the ones that aren't, but it's not that big of a difference. And statistically, it's a little hard to know. So I would say we're not quite there yet. I think time will tell. I think in a year or two, we'll have a lot more evidence. But as you pointed out at the beginning, aggregate productivity data are noisy for a lot of reasons. So you got to have a fair amount of data to be sure what's going on. I'd say now it's a little too early to declare that AI is here and showing up in the productivity numbers.
As we've said, productivity by definition allows us to create the same amount of stuff using fewer inputs, which should make things cheaper. But if there's any consistent thing about human nature through history, it's that whenever we get cheaper stuff, we have an insatiable appetite to keep consuming, usually to the point where the economy is back at capacity. So if AI does deliver on all its hype, what do you project its impact will be on inflation?
Like you said, it ought to decrease inflation. When we become more productive at building stuff, you're right, we do end up spending all of our money, which is more than we used to have, but it's often buy more of the thing. I grew up in a house with one TV. How many households have just one TV now? And certainly, how many households have one screen that projects content? Basically none. We just have multiplied as these things have gotten cheaper, we buy more and more of them. And that's true of goods especially, but it's a little true of services as well. So all else equal, productivity gains are cost reductions, which should lead to price decreases. Productivity helps keep inflation under control, but it doesn't guarantee it won't happen because other things can create inflation that quantitatively can swamp productivity growth at any given time. And so I wouldn't say faster productivity growth guarantees we'll never experience inflation again, but it ought to help, all else equal.
How does that then extend to interest rates, at least through history, or maybe your thoughts on this episode of technological innovation? So, if there's downward pressure on prices from productivity, that would mean lower interest rates, but the returns to capital are higher, which could raise interest rates. So, what is your general sense of what the data show for that?
Productivity growth for any given sort of condition makes inflation less likely. So you might be less apt to raise interest rates in response to things that you normally would have said, oh, we better tighten. So, for example, if we had 5% per year real wage growth right now, most people would say, well, that's overheating. We're going to end up with an inflationary spiral. There's no way that we can sustain 5% real wage growth year after year after year. On the other hand, if productivity growth is 7% per year, real wage growth of 5% per year is easily sustained. All else equal, the economy is running along, and now you increase productivity growth. We're all going to be wealthier in the future, at least on average. Theory says that should raise the interest rate because people are going to want to invest in producing output today to get some of those future gains. On the other hand, savers want to pull some of those future income forward to today. If I find I'm going to make a bunch of money tomorrow, I might go out and have dinner tonight. And so I want to save less, and both of those tend to increase the interest rate. So we sort of think the natural interest rate rises when productivity growth goes up.
I want to finish with a question about your projection for how impactful AI will be for productivity. So do you think it will be closer to a general purpose technology or transformative for just a narrow part of the economy?
I think it's a general purpose technology. I've written a couple papers on this with colleagues. And to give a sense, past general purpose technologies have tended to raise labor productivity growth by about 1 to 1.5% per year for 10 to 15 years above baseline. That's like a big deal. That is not the singularity. That is not mass unemployment, but that is a big deal as technologies go, something that's going to raise labor productivity growth by that much over that kind of period of time. That's kind of where I'm thinking it is. A couple of years ago, I was asked at a conference, what do I think? I said, I think it's going to be about 0.5% to 1.5% per year for about 10 years. I'm kind of still in that range. I'm more sure of that range. I'm more sure than I was a few years ago when I made the prediction, but I think quantitatively, that's kind of where I'm at. If we can get 1% to 1.5% for a decade, maybe a little bit more out of AI, that would be fantastic. That would be bigger than a lot of the big technologies of the past. That's kind of where my guess is. Can I rule out that it won't be 5% per year for 50 years? No. I mean, if it does, again, we're going to be really rich. We'll probably have to deal with some other issues that'll create. But we'll have a lot of stuff with very few resources expended. But that's kind of not where I'm thinking this is going to go. I think this is more like the general purpose technologies of the past.
Chad Syverson, thanks for coming on the podcast.
You're welcome. It's nice talking.
That was Chad Syverson, professor of economics at the University of Chicago. I think it's important to remember how, historically, revolutionary technologies have been diffused into the economy very gradually. Massive disruptions from rapid AI adoption are certainly possible, but the kind of dystopian scenarios that some are imagining would require an unusual pace of integration. The productivity gains could be big and, almost by definition, will happen in ways and parts of the economy we can't envision at this point. There will be downward pressure on prices, all else equal, but policymakers could find it challenging to identify these gains in real time. The war in Iran should continue to be top of mind for investors for the foreseeable future. Next week's data calendar lacks any first-tier releases, but the following week is much busier. Consumer confidence for March and the February jolts will be released on Tuesday, March 31st, followed by the ISMs on Wednesday and Friday. The March jobs report will also be released that Friday and show how payrolls growth fared this month after volatility in the January and February data. The unemployment rate rose slightly in February, but FOMC participants may feel that the war's inflationary risks take precedent over any labor market weakening for the time being. Fed officials are free to speak publicly about policy now that the pre-meeting communications blackout is over. A few appearances are on the calendar and more should pop up, but given the uncertainty regarding the war and macro outlook, we don't expect any firm guidance for the direction of policy. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.